Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So the next the indicator that we were chatting about was the RSI, or Relative Strength Index. And this is a particular indicator developed by J. Wiles Wilder. So you may, depending on what charting software you're using, you might see the RSI Wilder, and that's simply named after its creator. And the idea is that this particular indicator, or this particular oscillator, if you will, compares stock gains to stock losses, or pair value gains to pair value losses over a specific period of time. And what happens is the information is calculated to reflect a number between 0 and 100. And the idea is that when the number of gains are greater than the number of losses over a certain period of time, then you'll see the relative strength index rise. And of course, when the average loss is greater than the average gains on a particular time frame, then you'll see the RSI falling. So it helps us gauge where the momentum is in these markets. So if we were looking at trading a bearish opportunity, for example, and we felt that, again, the Pt6, for example, was going to move lower, then we would really be looking at the RSI rolling over, if you will, and moving towards the downside. So what we also do is we add what's known as a 50% line. And this particular mechanism for identifying particular directional bias is known as a center line crossover. The idea is that if it breaks above the center line, it's really showing a lot of momentum to the upside. If it's breaking below that 50% line, then it's suggesting that momentum is building to the downside. Now, if we take a look at this BPX chart once again, there's a couple of things that we can kind of do to pull everything together. What I want to do first of all is just again review just what we sort of talked about before. So we were, right away we were looking at this move into a resistance level. So the inability for the pair value to break above that particular price level, suggesting that if we're looking for a higher high to lend credibility to an uptrend, that we're just not getting it. The other was, of course, a break of that trend line that we'd really more or less established from just looking at this level, these 2 points right in here. We were also looking at the histogram here and the divergence taking place in the MACD, your MACD crossing over. Now, we move down to the RSI. Now, this RSI we have set up on a basically a 30-day or a 30-bar setup, which means that really the equation is just taking into consideration the last 30 days of price action. And so you can see that realistically, for the last little while, and you can see how this really correlates with this trend that was in place, we saw momentum really building to the upside. Now, we have our 50% line right up in here, but there's a couple of other lines that we also look at, and one is the 70, and I can't really draw it on here now because it's not there, but the other is the 30. And those indicate overbought and oversold areas. And so the idea is that as a particular, in this case, currency pair, trades higher and higher, that momentum begins to slow down. When the momentum begins to slow down, you get this kind of thing taking place in your histogram, you get your MACD crossing over, you get a little bit of a resistance level forming, and you also start to see your RSI tapering off as well. So we hit this overbought territory here. Now, I would not necessarily wait for a break below this 50% line, but the idea is that as your RSI drops down towards that, a break below that really lends further credibility to an even deeper retracement or an even greater continuation to the downside. And so the idea is that what we want to do is we want to pull all of this together, really, again, to come up with a high probable directional bias, and then look to the FX options option chains in order to establish a position, which might be just buying, in this case, a straight put option. We may want to create a bear put spread using a couple of different strike prices to lower the cost basis of the position. Whatever you feel comfortable with utilizing really is going to stem from what your analysis is in the price chart, and that's why we really try to reinforce the fact that unless it's very difficult to trade options unless you have an understanding of what the underlying security is actually doing, how it's performing, what kind of a trend is in place, whether or not there's any key support and resistance levels being tested, et cetera, et cetera. Once all that's in place, we find it's very easy to move from the price charts into the options chains in order to establish our positions. Now, let's talk a little bit about patterns. I'm going to wrap things up here just looking at a couple of different ways that we can identify patterns, and I'm under a little bit of a time frame myself this evening, so I'm going to try to button things up as quickly as possible. So but there's two types of patterns that we look at when we're reviewing a price chart. The first is, of course, a reversal pattern. Now, not surprisingly, there needs to be an existing trend in place in order for it to be a reversal pattern. We talked about the importance of that signal line, of that break of a major trend line. That's your first signal that the trend is actually changing. Couple of key characteristics that you can consider when you're looking at reversal patterns. The larger the pattern, the more significant the move tends to be. The other fact is that topping patterns tend to be shorter in duration and more volatile. And when you think about the psychology behind it, it makes a lot of sense. The fact is, when people see topping patterns beginning to form, they recognize that their profits are likely being threatened, and consequently there tends to be a faster move to the exit door than under normal circumstances. So you get that, the short-term pattern formation, and then that very volatile move as the market drops and everybody wants to head for the exits. Bottoms tend to have smaller price ranges and take longer to form, and the reason, generally speaking, is because once a move has taken place or a significant move to the downside has taken place, many people are a little more shy at putting their capital in right away, and tend to just kind of test the waters. They dip their toe in to see whether or not it's safe before they commit all of their capital. Now, let's just take just a quick generic look at what a typical topping pattern might look like. We've already looked at a double top. I'm going to use this as an example in a couple of minutes. But the idea is that we have a market that, of course, is trending to the upside. We have that test into a resistance level and a pullback. That forms the pivot point. We have a retest that does not break any higher, and a break of that previous pivot point signals the entry for a move to the downside. Well, really, this is nothing different than just putting the principles of support and resistance into play when we're looking at analyzing a price chart from that perspective. So recognize that a double top and, of course, the double bottom here that we're going to look at is really just an exercise in identifying key support and resistance levels.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.